I'm Jeni Browne. Welcome to this week's MFB News. I hope everybody is very well, warm and dry. You can certainly tell it's half-term week by the weather, can't you? But I hope everything's really good for you. Now, in terms of what we're going to cover for you this week, we're going to do our usual rundown, swap rates, lender pricing changes. I'm going to do a bit of a kind of summary about actually how mortgage rates look in real life. So we kind of do this from time to time just to give you a real sort of real life view on what's happening with pricing. We're going to do that this week. I'm then going to update you on my journey into preparing for making tax digital. So for some of us, this kicks in from April next year. So it's really sort of on the horizon now. For others, it's going to be in the future. It all depends on how much you earn. But the reality is that if you have a buy-to-let property, and most of you will do because you're watching this, at some point this is going to affect you. So probably worth hearing about my kind of experience of trying to find software which I can use to do my making tax digital return, which I'm really looking forward to. I'm then going to update you on what's been happening with the housing market, and then we're going to have a little bit of a chat about what's going on with the latest thoughts on base rate as well. Okay, so first up, we're going to talk about swap rates, our usual, just to sort of catch up with what's been going on there. And actually, for reasons that I genuinely don't understand, swap rates have come down a bit, which is great. So 2-year swaps, as of yesterday, 3.57, 1 month ago, 3.70, and 1 year ago, 3.87. So for the first time in a really long time, month on month and year on year, we are in a better place. And actually very similar story for 5-year swaps as well, which is fantastic. 5 years at 3.62. In the last week, they were kind of just over the 3.7, nudging up to 3.8. So down by circa 0.18%, which is fab. 1 year ago, 5-year swaps were at 3.67. So we're still slightly ahead of the game there as well, which is absolutely brilliant. Why have they come down a bit this week? Honestly, you know, there's so many things that go into swaps. Maybe Rachel Reeves is making better noises and has calmed the market down. Maybe kind of we're thinking about the future of the economy, and maybe that's not looking so rosy, and so actually then the prospect of base rate having to come down in spite of things like inflation, who knows? But actually this seems to, whatever it is, have fed through to the swap markets and pushed the rates down a little tiny bit there, which is absolutely great news. Okay, and then moving on to lender pricing. And actually in the last week, we have certainly seen a little flurry of people reducing rates. Now, don't get excited. It's not been large reductions, but sort of 0.1% off rates, 0.05, that kind of thing, which is what we've been seeing actually for the last few weeks. Some lenders are making additional reductions, some just are making their first reduction and catching up with everybody else. But actually, the reality is that we would much rather lenders were putting their rates down by even just 0.1% than putting them up. So we'll take that for now. So what I thought I would do is a little kind of roundup in terms of where pricing sits in terms of actual mortgage rates, because I think this is probably quite useful. We talk about lenders dropping rates down, but actually how does it look if you want to borrow some money at the moment? So to recap the kind of scenario that we use, so the average loan size for a buy-to-let mortgage in the UK is around £225,000. So what I do is I will work on the basis that the calculation I'll use is for £225,000 worth of debt at 65% loan to value. So just know that actually if you're looking for a 75% loan to value mortgage, it's going to be a different set of rates, but this is really just to give you a flavour of where things are. So first up, if we're looking at personal borrowing on a straightforward property, and let's also throw into the mix and a landlord with less than 10 buy-to-let properties as well, and therefore you're kind of getting at the vanilla, as we fondly refer to them here at MFB, lenders. So 2-year fixed rates from 2.24% with a 7% fee. So that's the lowest 2-year fixed rate you can get at the moment, 2.24%, but whopping fees. But actually, if we look at the overall cost over T's, and this is how we prefer to do things, so rather than kind of try and lure you in with very, very cheap headline rates, actually, if I'm going to borrow £225,000 and I'm going to borrow over a 2-year period on a 2-year fix, what deal is going to cost me the least when I factor in both the interest I'm going to pay and the setup cost? So this is the premise that we're using across this kind of whole segment. So lowest 2-year cost, a rate would be from 4.03% with a 995 fee. Same thing with your 5-year fixes now. So lowest rate is 3.66% with a 3% fee, but actually the best 5-year cost on those numbers for a loan of 225, and that would change if you're borrowing more or less. 5 years from 4.08 with a 995 fee. So actually, you know, we are looking at, particularly on 5-year rates, at, you know, it's just over 4% now, which, you know, is obviously some of us are going to think back to when we got a 5-year fixed rate of, you know, 1.98, and we're going to remember those days fondly, but sadly we're going to be remembering them for a really long time. Actually, this kind of like sort of circa 4 to 4.5% for a 5-year fixed rate in personal names, straightforward borrowing, that's kind of where the market is now. Limited companies, just to kind of repeat the exercise, but this time if you're a limited company. So 2-year fixed rates, your lowest 2-year fix is 2.24% with a 7% fee, but your better value overall is going to be from a 2-year fix at 4.81 with a £1,500 fee. 5 years, your rates are from 3.85 with a 9% fee. I mean, it's the lowest rate, I had to tell you about it, but yeah, 9% fee. 5-year cost 4.79% with a 1,495 fee. So I hope that's helpful, and I hope it kind of gives you a good kind of view in terms of where pricing sits at the moment. If you are curious about how the numbers work for you personally, do take a look at our website. Actually, there is a mortgage calculator on there. You can go in and put some very high level numbers in. You don't have to share your contact details if you don't want to. But in there, then we'll kind of churn through the system that we use in terms of looking at rates, and it's going to tell you what's available specifically for your own requirements. No cost involved and absolutely no commitment as well. Okay, now a little update in terms of where I am on my getting ready for making tax digital journey. It's quite ironic that I'm doing this because I haven't actually done the tax return that's going to be overdue come January, so I probably should focus on that first, but new shiny toys and all that, so it's quite fun to have a little look. So I went on to lots of landlord forums, and also some of you guys contacted me as well, and I've settled on trialling a piece of software called Hammock. So just to kind of backpedal slightly, in short, if you are in receipt of buy-to-let income, at some point you're going to need to do quarterly returns to HMRC rather than your annual tax return that we have all been doing to date. And you have to do this via a piece of approved HMRC approved software, basically. So because I am probably not the greatest person at admin, that's an understatement, to be honest, I'm terrible at it. The prospect of having to go through what I see as a huge amount of pain, quarterly rather than annually, means I've been sort of trying to ignore the fact this is happening. I'm sure this resonates with lots of you. But the reality is it does come into play in April for me because of how much I earn. So it's time to really pick this up. So Hammock is a piece of software. We have no affiliation with it. I'm literally just sharing this as my experience, and they've got no idea that, you know, I do these videos. There's no kind of relationship there at all. So this is purely based on me having a go and seeing what I think. So far I've been really impressed. So setting up my account with Hammock was really, really easy. Actually, you get a 1 month free trial. I think it's a month or maybe 2 months free trial. So I thought, what the heck, I'm just going to give it a go and see what happens. So basically you sign up, you key in some details about your portfolio. Obviously for me, I have one buy-to-let in my personal name, and so that was a pretty straightforward process. I appreciate for some of you this could be much more involved. And then what I did was I allowed it to access my bank statements, or my bank account, sorry, which is where my mortgage payments go out and my rental income comes in. So what it does is it essentially drags through the information from my bank account and pre-populates it into their software system. And then you literally go through and you could say, this is a mortgage payment coming in, this is rent going out, actually this is a payment for getting some work done at the property, and you literally start going through and labelling all of the things on the bank statement. And then what it's going to do essentially is provide a summary which goes off to HMRC. It's your quarterly return. So I've started the task of going through and labelling all the different transactions. So I'll keep on with that. I'll get to that in the next few weeks, and I'll provide you another update with how the summary kind of looks. But so far, actually, I have to be honest, for someone who is neither techie or organised, this looks like it could make my life really, really easy. I nearly thought, oh, I'll try and do it for the tax return for the 24-25 year, which I'm yet to do. But I figure that's probably a step too far. I'm not going to bother with that. But yeah, it's really good. In terms of cost, that's the other thing that you guys are going to be really interested in. So I'm going for like the really basic package. Why am I going for that? Because according to their recommendations on their website, because I have just one property, and I think really they're saying if you have up to 3 or 4, the basic package is really going to be sufficient for you. Then it's £6 a month. So not a disaster by any means. So there you go, that's Hammock. I will keep you posted as I keep going with this. But for those of you who are kind of thinking, that you need to sort of get across making tax digital and start preparing for it. Hammock, from my experience at least, and I haven't compared it to anything else, but based on what I'm seeing, and also lots of other landlord recommendations, it seems to be very, very good. We haven't talked about the Renters' Rights Bill for a few weeks, and I know everyone's saying, oh, it's going to be passed in the autumn, so you're probably just thinking, or you could be just thinking, what's going on? So I thought I'd just do a quick 30 seconds on that. So in the last week, the bill returned to the House of Commons for the amendments or proposed amendments to be considered, and debates here are including things like pet damage deposits, exemptions, repossession rules, and allowing courts to review whether properties were generally marketed before repossession. And so the Lords rejected some of the Commons amendments, and because of this process we're now in what they call ping pong, which is where essentially amendments are tabled, debated and either accepted or rejected between the Commons and the Lords. Now the bill is not fully settled yet, and minor changes are still possible. Please note the word minor, so no big changes, kind of real like mini details now they're sort of going back and forth on. So the bill is now heading back to the Commons with the Lords amendments for final approval before it receives royal assent and becomes law. So it is looking incredibly likely that this could be in the next week or two. But, you know, obviously there are, you know, it's a possibility that things still keep going backwards and forwards and it goes a little bit further than this, but it's very, very much imminent now. So once that happens, we'll let you know where we are, what rules have changed, anything you guys need to be aware of, and then we're going to start thinking about how we get ourselves all ready for the actual changes which will come in over the next 12 to 18 months. Now, for those of you who are eagerly watching the housing market, the UK housing market, to see what's going on, this one is for you. So the UK's housing market is showing signs of slowing down amid speculation that Rachel Reeves could announce tax increases on property in next month's budget. So essentially people are now kind of like, uh-oh, what's coming? Let's just hit the pause button for the time being. And that has meant that the housing market transactions have really slowed. So in a sign of growing caution among house hunters, figures from Rightmove showed that both the number of new buyers contacting estate agents about homes for sale and also the number of new sellers coming to market has slumped by 5% in September compared to the same month 1 year earlier. Now, Rightmove commented that the market remained resilient but warned that the typical post-summer bounce in activity was failing to materialise. Reeves signalled in a Guardian last week that those with the broadest shoulders should pay their fair share of taxes and promised new measures to tackle inflation as she draws up next month's crunch budget. So the Treasury has been exploring a new tax on the sale of homes at over £500,000 and the removal of capital gains tax exemption on primary residences above £1.5 million as ways to boost income for the government. All exploratory at this stage, guys. Nothing has been agreed for certain. There's also been debate around the introduction of a new council tax band for higher value properties in England. And the Chancellor is also facing pressure from Labour MPs to overhaul property taxes in next month's budget. Now, property experts are saying that buyers, sellers and high street lenders were hitting pause before the budget. There are some continuing jitters about what the upcoming budget might contain. A chap called Tom Bill, who's head of UK residential research at Knight Frank, said transaction numbers over the last 6 months, so properties transactions now, have been supported by stable mortgage rates and softer prices as sellers come to terms with the fact that high levels of supply mean it's been a buyer's market. However, demand is wavering for the second successive year as the autumn market gets underway, as speculation over the budget becomes a prolonged and frustrating game of guess the tax rise. I love that last bit. It really is, isn't it, at the moment? Yeah, it's a very, very leaky ship, it seems, or maybe a deliberately leaky ship in the Labour budget office at the moment. It seems that things are kind of coming out, lots of rumours, which is causing a huge amount of nervousness. Now, obviously, for you guys, if you're thinking about buying properties, and lots of landlords are saying the same things, I'm just going to wait and see what the budget unfolds first of all before I kind of do anything. Totally understandable. However, do note that actually the impact of the uncertainty and the build up to these announcements has meant that the housing market has gone really quiet. So actually, for those of you who are thinking, sod it, I'm going for it anyway, it does mean that the door is wide open for you to make some serious negotiations right now. Okay, so let's talk a bit about base rate and the latest kind of commentary that we're hearing around what's going to be happening there. And this is really stemming from the fact that the Bank of England's chief economist, a chap called Hugh Pill, urged decision makers in the last week to take a conservative approach to interest rate cuts in the month ahead, a day after an influential central bank official warned sticky inflation showed little signs of easing. So Peel told an audience in Washington that borrowing costs were likely to move lower over the next 12 months, but it will continue to be important to guard against the risk of cutting rates either too far or too fast. Stubborn inflationary pressures are the main reason the bank will need to be cautious in the coming months, as there is very clear upside evidence inflation will stick above the central bank's target of 2% for a longer period. Someone called a man at the Institute of International Finance was quoted saying, "I call inflation persistently persistent, and that is the principal challenge facing me as a monetary policymaker." Now, these pressures are continuing, so inflationary pressures are continuing despite sluggish economic growth and a mixed outlook for the jobs market, meaning inflation and getting it under control should remain the Bank of England's top priority. Now, Peel was quoted on Friday saying that the current level of inflation was disappointing and urged the central bank to adopt a more cautious pace in withdrawing monetary policy restriction so as to ensure continuation in disinflation towards the 2% target. Now, that doesn't mean cutting or scrapping rate cuts entirely, but rather holding rates steady in at least some of its forthcoming decisions. So essentially, Peel is saying, actually, guys, yes, rates can come down over a longer period, but it needs to be very, very slow, very, very gentle. And actually, in the next few months, it's probably not the right time to be doing this. And really kind of just to echo this sentiment, while the central bank has moved rates steadily lower since the third quarter of last year, financial markets, so essentially the capital markets, this is going back to swap rates now, see little to no chance that it will cut again at its next meeting scheduled for the 6th of November. So essentially, for those of you who are hoping for a rate cut in November, it looks like the financial markets have now basically priced out any chance of that happening at all. And so your next base rate cut will be probably now in 2026. And just before we wrap it up for a week, I just wanted to share that we've done our latest in our Meet the Lender series. And this time around, I was really delighted to speak to Isaac, who's our account manager at BM Solutions. And as with all of the lenders, Isaac had loads of really great stuff to say. But actually, one of the things that we talked about, which I found really interesting, was the number of applications that BM Solutions have to turn away because of credit profiles or credit scoring. And Isaac had some really amazing advice on this in terms of where they see often the challenges coming through. So here's a little excerpt of the video. You can go onto YouTube and watch the whole thing of the very good advice that Isaac had.
The most common reasons that you see BM Solutions declining applications?
So the most common reasons for applications being declined now, no two cases are the same, and it's a hard one to answer. But I will touch on probably what is a more common decline in terms of when a broker will reach out to a BDM, and it tends to be things like credit score declines. And I think what I'll definitely love to do is probably demystify that area a little bit. So one of the things is, underwriters use loads of different data sources, and one of the first starting points is the three major credit reference agencies. And there is a specific company out there that allows customers to have access to all three, and a lot of brokers use it as well. That would always be my starting point if I've given the best advice to brokers out there and clients, because just because you can see one credit reference agency and you might have a subscription with them, what that reference agency shows could be different to the two others. And it's such a common thing that happens. And it's not to say it in somewhat of an arrogant way, but whenever I get an email across and it's a credit score decline, I ask for the credit report showing all three bureaus, and 9 times out of 10 I can spot a specific detail that could be the reason why that case is not as strong as you thought it could have been going in. And once you've got access to those free reports, have a good look, utilize us as a skill set to be able to learn about what we're looking at. When we're rarely looking at the score, we are focused on the detail, we're focused on accuracy, things like multiple addresses, things like missed payments, things like adverse events that happen across a certain period of time. And this is where a BDM can be really valuable, because we can then advise whether an appeal route you're in the best place to do it, or whether it could be your time best spent looking elsewhere. So I know it's a roundabout way of answering it, but at least I can offer some guidance in terms of when that type of decline comes across.
Yeah, I think that's brilliant actually, because one of the things that you have mentioned that makes you guys really great to deal with is the absolutely brilliant service that BM Solutions offer to its borrowers in terms of speed of application, and also your ability to kind of take on large numbers of applications as the market fluctuates in terms of busyness. And the reason you're able to do that is because you do, as a business, to some extent lean quite heavily on technology to do part of the decisioning process with your applications, which is fantastic. But yeah, so obviously, you know, we have found that people do not pass credit score with yourselves, but also other lenders. It's not just specific to BM Solutions. And you're right, actually, you know, if you've got any missed payments, anything you would be showing on your credit file that could cause an issue, no. Pull the credit file, and lo and behold, there's a missed payment to Thames Water or something. So, yeah, that's really good advice about the 3 referencing agencies rather than just the one as well, because they don't always match up. Thank you.
And that's everything for this week. Thank you, as always, for your time, your attention. We really appreciate you coming along and having a watch or listen. If you have any questions, you know we'd love to hear from you. 0345 345 6788, or you can email in. You can go on our website, fill in an inquiry form. You can also do an online chat. You're talking to real people. I promise there are no robots speaking to you via online chat system. But whichever way it kind of works for you, we would love to hear from you. Have an amazing week, and I'll see you next Wednesday.